I've been asked by our community to make a video explaining how to invest every month with different amounts. But what amount? What amount is a perfect amount of money that large portions of the nation can actually afford? And what could be a strategy that works for, say, £50 or £300? So I've kept it very simple and picked £100 or a ton if you're a Cockney lad like me. I want to keep your feet on the ground, so if you're expecting me to be like, "This time next year we will be millionaires," then sadly that's not what we're going to be doing today. Those of you who get that are my people. I want to show you how you can grow £100 a month into a pretty decent return through investing it regularly every month and letting that thing called compounding work its magic. For me, there are three main ways that everyday people like you and me can actually invest their money. Number one is the stock market. This is certainly the most attractive and, in my opinion, the easiest route to get started, as you can get started with £1 these days with some accounts. Number two is property. Now, for most, this takes significant capital. Although there are strategies to use other people's money, buying property just means you're going to have to put in some money, which £100 doesn't really cover. Certainly something to look at later down the road, but today we're going to park property. And number three is investing into yourself. Now, this one I'm a big fan of, because if we turn that £100 a month into £300 a month by upskilling ourselves, then it makes investing into the stock market a lot juicier. So in this video, I'm going to focus mainly on investing in the stock market and investing into yourself. Both can be pretty powerful, but let's start with the stock market. For those of you expecting me to make a video about trading Forex or crypto borrowing, then you've come to the wrong place. I totally respect that they are avenues for some to explore, but the risk is simply too high. And so I like to take the traditional long-term investing approach, using tried and tested methods that anyone can actually put into practice. Now, lots of you will go, £100 isn't that much. Well, this is where you'd be wrong. If we invest £100 a month, then in 1 year we could have contributed £1,200, and over 10 years that's £12,000, and over 30 years that's £36,000 just in contributions alone. And if we take a calendar year and invest every single month, some months we're going to see profits and others it's going to go down. That's just the nature of investing. But overall, we want to see a 10% return on investment on average per year. If we did that for 1 year and got 10%, we'd now have £1,320. So this would have made us £120 in gains. The bit where it gets very interesting is when we put this over longer periods of time. So in 10 years, you could potentially have £20,755 with £12,000 contributed. So that's £8,655 in gains. In 30 years, you could potentially have £228,032 with just that £36,000 that we said before, which was contributed to it. And that's a whopping £191,932 in gains, which is a big difference, right? Big difference from the 30 to the 10 years. So compounding is literally working its magic. Essentially, it's slow at the beginning because most of the money is your own contributions. But every year, if we got that 10% on our money, that's growing year on year, and that's now making us money too, which means our money grows more each year than it did in the last if we get that 10%. So going back to the, oh, I've only got £100 to invest, that's not worth it. If I said, well, set it up and forget it and do that every single month and come back in 30 years, would you turn down £228,000? I don't think you would. The key contributing factor is time. So delaying your gratification is hugely important in my opinion when you invest. And sure, £100 can be increased. If you invested 2 or 3 times that a month and got 10% return, then you could be pretty well off at the end of it all. That's why you see all these videos about turn an average salary into $1 million. And while it's annoying to see that clickbaity stuff all the time, but it's an actual strategy and the maths behind it is very, very simple. Now, Sammy, what are you basing this 10% off? Well, I'm actually basing it off something called the S&P 500, which is the 500 largest companies in the USA with 8 of the 10 biggest companies in the world in it. And it's a pretty decent benchmark for how the world's economy is performing due to the big companies that we all know within it. Those Apples, Microsofts, Teslas, Nvidias, as well as hundreds of other massive companies that you'll know, just like Coca-Cola, JP Morgan, and MasterCard. In fact, the S&P 500 has returned slightly more than that 10% since its inception in 1954. Its actual return is 10.26%, but it rarely actually hits that number. In fact, most of the time it's nowhere near 10%. And some of these returns over the past 30 years, you can see here, will demonstrate that. So it's important to know that that 10.26% is an average. But as you can see here, there's more green there than red, which is a positive. But one of the most important decisions you will make is what type of account to invest into. Now, I would place my £100 into an ISA, most importantly, a stocks and shares ISA. Now, many get confused that the ISA is the investment. It's not actually the investment itself, it's the account you use to make the investments with. So imagine the ISA is the basket and the stock market is your supermarket. You take the basket to buy the items and then you put them into your basket, which is where they live. And that's exactly what an ISA does. The main benefits of this is that anything you make from a stocks and shares ISA is entirely tax-free, which wouldn't be the case if you invested into a general investment account. So if you did make that 228,000, you keep all of it when using an ISA, something which I'm sure all of you listening would much prefer. Now, my two favorite stocks and shares ISAs right now are Trading 212 and Invest Engine. Trading 212 will start there. They offer 0% platform fees and have funds, ETF, and individual stocks available in their thousands. For me, any fees kept means our money is working harder for us. So I really like their model, and it's actually where I keep my own ISA now too. They also have a really cool offer, which if you deposit £1, you get a free share up to £100 using my code GAINS, which should be on screen now. They also have a really cool feature as well, which allows you to create your own pies, which you can hold multiple funds and individual stocks inside. And you basically set how much you want to go in them, and you can set up automatic investments into your pie each month. Now, number 2 is Invest Engine. I also really like Invest Engine. They're slightly different to Trading 212 as they focus just on funds and ETFs. This means you can't buy individual companies, but they do offer things like thematic ETFs, which are essentially funds where you can invest into areas such as electric cars, green energy, technology, and many, many more. They also have 0% platform fees, which is fantastic in my opinion. And right now we have an offer running with Invest Engine for new accounts, which gets you £50 bonus when you invest your first £100 with them. Now, what I would do in this example, if you can't pick between them, is I would actually open both ISA accounts, as you can have as many as you like now since April of this year. Live with them for a little bit and then make your decision based on the one that you enjoy using more, as they're both great in my opinion, and it is really important to actually like where you invest, the actual app itself. Now, I've left links to both of these in the description below, but we are not done yet, people. I can hear you going, this sounds great, but you've only spoken about the S&P 500 so far. So would you put that entire £100 into the S&P 500? Well, personally, I actually wouldn't, simply because I don't want all my investments to be solely reliant on US companies. What I like to do is I actually split my investments up into multiple funds. You can either equally weight them, or you could weight them more to others. And what I do is, say we have £100, I put 50% into a global index fund. Now, there are lots of different types of global index funds, but the ones that I like are the Vanguard FTSE All Cap, which holds 7,000 plus companies from all over the world. Yes, it has 60 to 65% USA companies within it, but it also holds businesses from the UK to Japan and everything in between. This for me just further diversifies my investments, meaning I'm definitely not placing all my eggs in one basket, or in the case of the S&P 500, one country. But what about the remaining 50%? Well, what I do is I add 30% to the S&P 500 and then 20% into the UK FTSE. Now, I'm actually pretty bullish on UK equities right now, simply because when you look at the price of the UK companies versus USA businesses, they look pretty undervalued in my opinion, but that is not financial advice. Definitely do your own research on that. And when you look at the UK, what I will say is we've had a pretty tough time. Brexit, Liz Truss, and of course, what shall not be named in 2020. Now, if you want to take this one step further and add some individual companies to this that you might like, what I would do is I would say you've got that £100 again, I would take 80% of it and tuck it into index funds and ETFs. And then I would put £20 of that towards the individual companies. Now, you're probably wondering, well, you can't buy £20 worth of individual companies. Well, friends, you actually can, and it's called fractional shares. So I can own a very small part of a share now and still benefit from its performance exactly like I would if I owned a full share. So for example, on Trading 212, I could buy £10 of Apple stock, for example, or even £5 and split it up nicely over a range of different companies that I like. But you don't need to do this if you don't want to, because investing into funds means they're doing that work for you. I just like to do this because I use certain knowledge that I have in certain fields and my many years of experience of investing now now to just get a bit of an edge and pick in businesses that I like and I think that are going to grow in the future. But you don't have to do that. Okay, so we're going to come to investing into yourself now. Now, the example I like to give here is, let's say John invests £1,000 into a course, which would automatically mean he gets promoted at work once he completes it. Obviously, this is a hypothetical example, but let's say he gets paid £15 an hour right now. And when he completes that course, he's paid £22 an hour. That right there is a 47% increase in pay, which is very decent return. And even at the 10% a year that we could get from the stock market would mean over 4.5 years to get the same amount back. So increasing your income is the biggest driver here. And by doing that periodically, you could take your £100 to £200 a month or £300 a month, which, as we've seen from earlier, will make a significant difference to your wealth at the end. Now, I'm a firm believer of investing into yourself will pay more than anything else, because if you're smart about it, then it will mean you earn way more in your lifetime. Life will get better, you can invest more. And I think the perfect video to follow on from this is how I built my own £130,000 investment portfolio, and most importantly, how you can do it too. It should be coming up on your screen right now, and I'll see you over there so we can continue learning about this in a little bit more detail. It's been a real pleasure, and I'll see you guys on the next one. Peace.